Yes.
So good afternoon. Now we are going to discuss about an interesting case study for tax avoidance. We had an earlier session about the tax avoidance. Now let me look into the case study of Flipkart. Before starting the case study, okay, you know very well about Flipkart. It's originally started by two friends earlier worked for similar kind of business. Chachin Bansal and Benny Bansal. Both of them started the company. You know, earlier they started with the selling of books through online. Later they have diversified. Now everything is available. So they have diversified into, they have introduced many verticals: mobile phone, accessories, computers, home appliances, electronic goods, and the other thing. For that, they need huge volume of money, so they went for obtaining funds from different sources. In that, Flipkart has received funds worth of 4.5 billion, is it the biggest funding in July 2014, and another 1.4 billion during April 2017. Even if you look into the major investors, those who were generously lended or made their investment in Flipkart by considering their growth opportunities. Okay, last year's Steadview Capital, again a powerful company which is making investment throughout the world. Daiher Global Management, please remember this particular name. DST Global, Axel Partners, Dragonir Investment Group, and Bali Gifford, GIC. There are many companies they were part of it, including Microsoft made investments in Flipkart. The accusation to support with the help of that funds, a huge volume of funds, what they mobilized, they started, making accusation of some companies also. So with the help of that funds, they made it, they become very stronger in different, the product base, the spectrum of product base also increase. Okay, the competitor, major competitor, even right from day one, they are facing it from Amazon. There are many many competitors like Myntra and other thing. Indian, localized competitors also taken over by Flipkart. Now coming to the core element behind the case study is the tax avoidance. See, this will explore how investment fund companies exploit the tax agreements between the two countries. Okay, you can make agreement with any country. Say if you make any agreement with Singapore, so you'll have some favorable terms for both people. Okay, if any revenue is generated by a Singaporean by making investment in India, they'll get a favorism. Likewise, any Indian make investment in Singaporean firm, they'll get a lot of privileges and other thing. So the story involves the famous case of investment by Walmart in Flipkart. So let's see what was involved in the case and what argument was made by the investment fund involved in that area. Tax avoidance, yes, of course, we had a earlier class. The use of legal methods to minimize the amount of income tax owned by an individual or a business. So this is coming to the real face of the case. Prior to that, you must understand what is Mauritius Treaty. Okay, Mauritius and India will have a tax treaty to start with. Suppose an investment by a company based out of Mauritius made a lot of money by selling shares of an Indian company. Indian authorities won't tax the gains you made. You'll be making the value difference. Say for example, you made an investment of 100 crore. Now you are making the sale of such shares for 150 crore. You are making a gain of 50 crore. So for that, the Indian government will not charge any taxes. But since Mauritius does not tax capital gains, you get away without paying capital gain. But the incident where India, 50 crore revenue you have gained, the Indian government will give a flexibility in not taxing you. Whereas in the Mauritius, because the company made an investment from that, so Mauritius also they never charged any taxes on capital gain. So no need to pay in India as well as in Mauritius. That's a real benefit people have enjoyed. But by understanding that gap, the tax benefit, how the people are enjoying it, particularly because of Mauritius treaty, the government decided to make some amendments to restrict that gap, okay, to facilitate, to ensure at least a minimal revenue for the government from such gains. It was made in 2016. They made amendments to the treaty in the year 2016. I think you might have seen the earlier slide. All investments pattern, all investor they made their investment during 2014 and 2016. The amendment was made in the later 2016. But now the question, the company, when the other side, the second part of the case, you look into that. The Tiger Global Investment is one of the earlier investor in Flipkart. They made investment in 2014. They had 22% of the company holding shares. They hold 22%. What and up to 2018 they were adding it. So 17% of the shares they've sold it to Walmart. So Walmart interested to invest in Indian e-commerce firm. They decided to make an investment in Flipkart. So the shares which were held by Tiger Global Investment that was sold to Walmart. See, Tiger Global made its investments through funds based out of Mauritius. Since Tiger Global has made most of its investment during the first half of the decade, obviously before 2016. So the amendment to the treaty was not really applicable to them. Yes, of course, any law implemented, they will give with effect from date of implementation. Okay, but the entire story was happened earlier to the amendment. So the people started claiming that okay, it's not applicable for us. So first side, this argument seems okay, legit. No. We have made an investment in earlier 2016. Law was passed in 2016. 16. Why you were okay claiming us to pay tax? Okay. Let me go deeper into the case by going through three arguments. There are three arguments. Once, okay, the funds were okay operating out of Mauritius. That one, the basic underlying principle you must know. The directors were discharging the duties in Mauritius. All in all, everything was firmly placed in Mauritius. This is the core understanding we made it from the case. But if you peel back the layers, you will see that these funds are ultimately owned by Tiger Global Management LLC ESC, okay, through a maze of holding companies. So holding companies. So there is another second layer. It's not directly from that. The second layer. So the tax authorities argued that Tiger Global had in fact set up the Mauritius-based entity for the sole purpose of avoiding taxes. I think yesterday in the class also you discussed. Some of your students suggested, sir, if any tax burden is huge, let me open one entity there just to minimize the same thing reflected here. So it was found that, okay, so they might have established an entity just to avoid the tax. That was the one thing. Okay. See, and therefore contested that they should not be exempt from paying tax on gains they made through, okay, the Flipkart transaction. That's the legal binding the government has. Tiger Global, okay, left with the taxman, took the matter to the quasi-judicial body, the Authority for Advanced Rulings, okay, AAR. So they'll be involved in solving the disputes, okay, the major disputes which is happening, probably, with the cross-borders investments and other things. And the case begins, let's look into three arguments. The first one focus on the transaction, not on the entity that involved in the transaction. First thing you can add, why you are focusing on the entity involved, focus only on the transaction. Tiger Global Investment Funds Council had the following argument to make. It must be proven that the transaction itself was designed to avoid taxes. They are telling that prove it, okay, we are ready to accept. Just prove it, okay, only for that. And proving that the structure of the entity undertaking the transaction was designed for the avoidance of income tax should not be necessary here. So the revenue had failed to discharge the burden of proof. But AR didn't agree with this argument. No, they were not in a position to generate the supporting documents, but still ARR had the doubt in the deal. So what ARR argument? ARR said that you don't just compute taxes by looking at the financial transaction. Don't isolate the transaction and take it into consideration. Just consider the other factors too. You look at the transaction as a whole. When were the shares bought? What was the purchase price? What happened in between? who is the primary executor, I mean the person or team behind that particular transaction, what's the appreciation in value. You look at everything. So they have given the instruction guidelines to look into that. More importantly, the head and brains executing the transaction resided elsewhere. You know, the person or team sitting, those who are involved in the core operation of this one, investing funds in Flipkart, okay, taken by the person, taken by Walmart, okay, it was found that it's by somebody else. Tax authorities had shown rather, conclusively that certain Mr. Charles P. Coleman, okay, operating out of US-based entity was the beneficial owner of the fund. Finally, okay, they found that the person behind the entire case, entire story. And he was primarily responsible for the most management decisions. So, what were the decisions taken in that case? Okay, there was from the Charles P. Coleman. So, they are hit back with the following observations. Yeah, in our opinion, it is not the holding structure only that would be relevant. The holding structure coupled with prima facie management and control the holding structure, including the management and control of the applicants, would be relevant factors for determining the design for avoidance of tax. It's not only related to transaction, it starts from the decision center, from where it was originated, how much money they have made it, purpose, everything. The applicant companies were only a see-through entity. See-through entity. Whatever instruction they got, it simply they have executed. To avail the benefits of India Mauritius DTA, Double Taxation Avoidance Agreement, which is a part of Mauritius Treaty. This is the observation they given. So based on that, what are the past judgments? If you look at the Tiger Global had another weapon in its arsenal, past judgment on the matter, specifically a particular ruling in the case of Modi's Analytics Inc. ARR in this case, conceded that capital gains occurring to Mauritius-based entity from the transfer of shares of an Indian company should not, ideally be taxed. Earlier case, similar kind of thing. Modi's Analytics Inc. That's a corporation which had same similar type of thing. So they were referring the case, stating that this the same thing was happened. So Flipkart, it's a Singaporean company, so pay the taxes. Again, further invading. If you look at the interesting part of the case, further invading, ARR said that in this particular case, gains were made by transferring shares of a Singaporean company, not an Indian company. Again, the further invading they made it. That's right, Flipkart is based out of Singapore. They found it. And Flipkart Singapore is the strategic shareholder of a Flipkart India. Okay, again, look at that, they made it a Flipkart Singapore is the strategic shareholder of a Flipkart India. Again, Flipkart India is the entity that owns most of the capital assets. It's not the entity of Flipkart Singapore, it's an entity of Flipkart India. The shares that were sold to Walmart, that Flipkart Singapore, not Flipkart India. To whom you have sold it? Not for Flipkart, it was sold to Flipkart Singapore. Okay. So, but the Indian Mauritius tax treaty agreement is only applicable to the transfer of shares of Indian company. They found that it's not by Flipkart India, it was done by Flipkart Singapore. So finally, this is the structure, basic structure, what has happened. Investor group 1, they did investment 23, investor group 2, the remaining. So Flipkart Singapore. So enterprise value is valued as 218. When you look into that, Walmart, so they got a certain portion of thing in that. So this is a basic structure. Okay, the people have identified, and that was imposed. And conclusion, ARR concluded that there was no doubt that Tiger Global had set up the Mauritius-based entity, like an artificial thing to facilitate this transaction to avoid paying taxes, and therefore should be liable to pay what the income tax authorities deem fit. I think got a clear idea about all sides. One side, the investment pattern. Then where they made an investment, through whom they have routed the money, and the purpose behind the sale. The purpose behind the takeover, Walmart, they have taken. But ultimately, the ARR found that this mainly because of getting the benefit out of it. So there is an affinity entity created, okay, to facilitate the transaction to avoid the tax avoidance. This is an interesting case study. I think I have some work to you based on this case study.